Hey, it's Soleil, and this is episode 31 of the Red Pill to Orange Pill Investor. I've been trying to do a video a day for 2024, and I almost missed yesterday. Almost every day. I'm going to take like 2 weeks off or something. So I'm shooting for like 350 episodes for the year. So I hope somebody's enjoying this shit. I'm actually having fun making them. So worst case scenario is I'm the only one who has fun. That's fine. But today I picked up another couple hundred shares of Riot. I guess I kind of figured out what was up with Robinhood's margin. So once I had used all of a certain amount of buying power, like they're still giving me some buying power, but the margin's already been used up. So anything that I purchased now, I just paid full price for it. But I'm expecting this to be the beginning of the next Bitcoin bull cycle. So I went ahead and I'm like, okay, I don't want the buying power to just go to waste. So I picked up a couple hundred shares at 11.31, which brought my average price to 12.81, and the price is down, of course, to 10.79. But before I bought these couple hundred shares, I think my average price was like 14 or something. And so what I immediately did was I sold some calls like right at the money, whatever the strike was above at the money, and I think the price was like 11.25 or something when I bought them. The price almost immediately like went above my strike, so it looked like I was going to have to pay to buy these back. But then, of course, not long after that, the price came back down from wherever it was today. Yeah, it was up a little over 11.50 today, but now it's back down to 10.80. And that's to be expected. Bitcoin is volatile, and all the Bitcoin mining stocks are going to be volatile. However, by selling these two 11.5 calls for 29 cents each, I reduced my cost basis by $58. So I guess if you want to divide it between the 400 shares, my average cost is really like $12.60 or something. Of course, I've sold a ton of other covered calls. I already had covered calls at 12 and 12.5. That also reduces my cost basis. Got paid 33 on that one. Got paid 21 on that one. So every one of these calls reduces my cost basis. So this 12.81 does not really tell the whole story. I've mentioned In the Money's channel, YouTube channel, before, but I think on his covered calls, or maybe that one as well, but his wheel strategy one might have it as well. He's got a nice spreadsheet, and you can track it. So if you bought 12.81 and then you sold 33 cents, you can track that your average cost now is 12.48, and every week that you sell a covered call, you can see what the price is to compare it to what you bought it for and what your cost basis is, and see what kind of profit or loss you're at any given time. That's pretty helpful. But yeah, I mean, you don't even have to look at your account during the week. So today's a Wednesday. It's halfway towards expiration. I always roll on Fridays for the most part. And I mean, you don't have to come in here. If you're doing covered calls and you're selling weekly, you can literally just check your account once a week on Fridays and roll your call. So close the call you sold and open a new covered call for next week, and you can really just do all your trading in like 30 minutes to an hour, depending on what you have. I used to have tons of assets I don't know if you'd call it a diversified portfolio exactly, but I'd go here to Market Chameleon and just filter on the implied volatility rankings, look for anything that had a ton of implied volatility, and then check to see if there was good premium on covered calls that you could get against this. But it wasted a lot of time. So I would have to, like, okay, let me check PHUN, let me go check EVA. Sometimes they wouldn't have weekly covered calls. Sometimes they'd only have monthly, and then I'd have to decide, okay, is the premium going out to like 45 days? Is it worth dealing with this or not? And it was kind of like, okay, well, why do they have a high implied volatility? Something like, there might be a lot of pharmaceuticals in here, and then in order to do your due diligence, you'd have to go and check, do they have fucking drugs in the pipeline? Are they about to have a big decision? And if there is a big decision about whether something's going to get approved or whatever by some regulatory agency, this could shoot way up, but that's kind of not really what covered calls is about, because covered calls are about limiting your upside. So it was just a lot of work, and it was profitable, but I've basically kind of gotten away from, Jesus Christ, Nicola's still here. I traded that temporarily. Vaxart as well. Yeah, I would just trade anything. Anything that would generate a lot of premium, and never really fall in love with any of these stocks long term. So, and here, let me just click on one of these. Let me just click on Nicola, really, just for shits and giggles. I'm going to let you sign in. Okay, good. Let's look at the... Shit, I haven't been here in so long. The historical chart? No. They're going to want me to sign in. Never mind. Anyway, so you could go here and check the implied volatility chart. Oh, you can actually see it behind here. So let's just say that this was, I don't know if this actually is Nicholas. So implied volatility is generally a mean reverting statistic. So it can go anywhere from 0 to 100. And it usually just trends around here. And then maybe something big happens or is about to happen, and implied volatility will crank way up. But then after this binary event, or, for whatever reason, nobody gives a shit about this stock anymore, and then all the volatility dies down, and it just reverts to the mean. Whatever this stock's kind of average implied volatility is, it also trends up a lot of times right before earnings, because there's a little bit of anticipation for earnings. So sometimes you'll see in a 12-month period, you'll see implied volatility creep up before earnings, and then after the earnings call comes down, we know what earnings is, so there's no anticipation about it anymore. And then implied volatility will drop back down, and sometimes you'll see that based on a company's earnings calls. But I just spent a lot of time just going in here, checking charts, checking when does this company have earnings, what binary events do they have coming up, do they have some big announcement, are they in bankruptcy proceedings, are they, whatever. I was just doing tons and tons of research. And now I've basically done completely the opposite. So before I would trade anything and everything, and now I just trade Tesla. I believe in its future. It seems like it's the clear winner in the EV space, but not like EV space is just a drop in the bucket compared to what the things that they're working on. Solar could dwarf their EV sales. The humanoid robot could dwarf their EV sales. Their AI could dwarf their EV sales. Their full self-driving could dwarf the EV sales. And that software model, you know, they're going to charge people a fee, and they just keep collecting monthly fees. And they, you know, they already built and sold the car. They could probably build and sell the car for nothing and then just make money off the software. I'm missing something. What else are they into? I forget. But regardless, they the robo-taxis. So, you know, they might end up with like a fleet of frickin' robo-taxis that puts Uber and Lyft out of business. They're already putting all the gas car companies out of business. And so anyway, I've decided that on average, I should be invested in Tesla. And if I'm going to be invested, then I want to, I think Tesla was, it was probably around 187 or 189 when I sold this covered call. So the price was down here. So I gave a little bit of room for upside. I collected about a 1% or so on premium. And it doesn't really sound like much, like, oh, there's only 1% call away value and 1% premium. However, if the stars aligned and I was able to collect 1% every week on the call-away value, that's 52% a year, and then 1% on premium, that's another 52% a year. So I could basically double my money just getting 1% call-away value and 1% premium. Now, that's best case scenario, but that almost never happens exactly the way you want it. Sometimes it'll go up to 195 and you got to come out of your pocket, you know, $250 or whatever to cover that. Or the price will drop, you know, way down here and you only have to buy it back for a penny, but then you may not get to sell and get 1%, like up here where you were able to get 1% at 190 and collect $190. Now if the price is 180 and you're trying to get 1%, you're only going to get 180. So it's not a get rich quick. It's not like too good to be true type of thing. It's just kind of like a chipping away. It reminds me a little bit of the book Atomic Habits, where you're trying to get 1% better every day. This is basically just trying to get 1% better every week. You have the potential to get more than 1%, depending on the call-away value. But if you get 1% better every week, after a year, that's 1.01 raised to the 52nd power, you're 67% better than you were a year ago. That's, you know, Atomic Habits is talking about personal development, but if you apply that same strategy to your trading account, then you're trying to get 1% better every time there's an expiration. So you can get 1% better by February 2nd, you can get another 1% better by February 9th, you can get another 1% better by February 16th. And what most people do is just either buy and sell all over the place, which they're not cut out for, because almost no one is cut out for day trading. You better figure your psychology out and study, read books, and learn how to do it. Most people lose their money. But even like I follow Stephen Mark Ryan every day, and he's always talking about he's, you know, not smart enough to time the market or whatever, so he just buys. Like I think he bought like way back here in 2019 or whatever. He might have bought before that, but he just buys and buys and buys and buys. He's got residual income from properties and all that shit. So he buys at 20, he buys at 60, he buys at 125, he buys at 275. He was probably buying at 407 and just didn't give a shit. and then, he rode that all the way back down to 100, and of course, he shits on everybody that panic sold at, around 100, and then, he's riding it back up and down and up and down and up and down. So that that generally is the best strategy for most people, because they don't have the stomach. They don't have the stomach for these peaks and valleys. If you bought here thinking it was going to go to 500, and then you lost half your money, you saw your account get cut in half or by a third or whatever, that's brutal. So if you don't have a mental plan for how to deal with that, if you're not resilient, then you might buy it 300 and sell it 200, and then you won't even be able to sleep. If you panic sell and then it goes to 400 within a year, it'll be hard to talk you off the ledge. So while that strategy of just buy and hold for most people is the best strategy, I am looking to see how I can be active without being a day trader and just try to get a little better every week. So I might have to rearrange my my holdings, because I'm not getting a lot of premium out of Tesla. So I believe that the stock will move, but if I'm only giving 1 or 2% callaway value on Tesla and the stock goes up 10% based on some kind of news or whatever, then I'm not really fully participating. So MicroStrategy is my favorite for getting premium and callaway value, actually. This is Wednesday, so you're only going to be able to get about half of a full week. But even at the money, like 1% would be $5. So you can get over 2% premium at the money for half a week. Multiplying that out for the full week, that would be 4%. But even doing like 5% callaway value for the week is great. So like 12.5 would be reasonable. So what would that be? 5.10. So 5.10, you can get 1.5% premium even for half a week, and you can get, what is that? 2% callaway value, a little more than 2% callaway value. So I think I have the 525 call. Yeah. And I think the price was around 500. So I was allowing for 5% callaway value, and I got paid $9.30. So I took almost 2% premium, and I left 5% callaway value, which it doesn't always work out this well, but that's almost, well, MicroStrategy was up to 525 earlier. So that was almost perfect. If it just had went to 525 and then stayed level all the way to Friday, that would have been the perfect combination. But it's back down to 500 now, which is fine. So as it stands, I stand to be able to just buy this back on Friday for nothing, pennies, and then I'll do the same thing again next week. If the price goes at 500, I'll just sell the 525 next week, collect some premium. If the price goes up 5%, then I'll collect. Well, not that I'll collect it, but my account value would go up by 5%. But that's never, you don't actually realize that profit until you sell. But of course, if you sell, then you have to pay taxes on it. So, and I'm already paying taxes on the covered calls that I sell every week. So that's another consideration. I'm not a financial advisor, and I'm sure as hell not a tax advisor. But this 67%, it's mostly going to be in the form of covered call premium, which is probably going to be taxable, and it might be taxable at a fairly high rate. But it doesn't really bother me, because like the SPY gets you like 10% a year or something. I don't know, maybe 15 if you're lucky. It basically gets you whatever inflation is. So if you want to know what the inflation rate is, just check and see what SPY is appreciating annually, and that's pretty much a proxy for inflation. So you don't have to check the government's bullshit website, see what fake ass number they have for inflation. You can just check the SPY or the VU. And so yeah, I mean, if I get 67% return as opposed to 10% return, I'd rather pay taxes on 67% than not pay taxes on 10%. I mean, you're going to have to pay taxes on it eventually, which I still kind of don't get. It's like, oh, well, you'll cash out at retirement when you're not making as much money. But if you make yourself wealthy, then how are you making less money? Like, if you turn yourself into a millionaire or some shit, and you want to live like one, you're going to have to cash this shit out. I don't know. Maybe, but then again, I hear rich people never pay taxes. They just borrow against whatever they own, and they just never pay taxes on anything. But I don't know if that's fake or not. So maybe if I get that much money, I'll be able to hire a tax attorney that'll figure all that shit out for me. But yeah, I'd rather, if my boss came and said, I'll give you a 67% raise, but you're going to have to pay, 20%, 30% taxes. Okay, I'm going to pay 23% of that. Well, that's still 44% that I get to keep, and 44% is a hell of a lot more than 10%. So I don't give a shit if they're making pay 50% taxes on this. I'm still 35% left over is more than 10%, and not pay taxes on it, and just defer my tax burden until some ancient age, whatever. Now, don't get me wrong, I still trade the same way in my IRA. And actually, it's more fun to trade in there because I don't have to worry about the taxes. I don't have to worry about, wash trading, or if you buy and sell it within a 30-day period. I don't know. There's too many freaking rules, and because I'm a high-frequency trader, I have a shitload of transactions at the end of the year. My transaction download is just pages upon pages upon pages. So it does make taxes a pain in the ass. But either way, that's the deal. Try to get a little better every week. 1%, 2%, 3%, 4%, 5%, whatever. And then do it again next Friday, and the Friday after that, and the Friday after that, and the Friday after that. And hopefully the aggregate of those improvements will add up to a sizable sum at the end. All right. I think that's more than enough for now. Pretty good, Joel.